Okay, thanks everyone. It is now just after 10, so we can get started with this webinar, and I trust everyone can see and hear me okay. I have a plant in the audience to give me any info on any issues in that regard. So just quickly, by way of intro, so you know, those of you who didn't attend via the Group 10 invite, came in elsewhere, just quickly, Group 10 Metals is a member of the Metallic Group of companies, which are three leading mining exploration companies focused on district scale projects in top North American jurisdictions. Group 10 specifically is exploring in the famous Stillwater district of Montana for battery and precious metals, specifically nickel, copper, cobalt, and the full suite of platinum group elements, platinum, palladium, rhodium, as well as the lesser PGEs, and cobalt plus gold. So it is a full suite polymetallic project of, well, we think enormous scale, and we're fleshing that out as we go. So just quickly to give just introduce our President and CEO, Michael Rowley, who will join us via video and audio here to just give a quick 3 or 4 minute overview of the company, and then we will introduce Jeff Christian from CPM Group and get started with the full discussion and the Q&A. So as Mike turns his audio and video on, we'll just go through a couple of housekeeping items, typical. I'm sure everyone's done a lot of these by now. At the bottom of your screen, you will see the Q&A button. At any time, please just click that button and ask a question for Michael or Jeff. Also, if there's any type of issue, there is a raise my hand button. Just do that and I'll see if I can address it as any technical issues.
I actually can't turn my video on, Chris. I think you or Rob have to let me in. Sorry about that.
That is quite all right. Let me address that. You'd think we would have these things perfected by now, but clearly not quite. So there you go, Mike.
All right. Thank you.
Okay, so Mike, I'll just let you take it away. Maybe give everyone, if they didn't see that quick video, just give us the 3 to 4 minute Group 10 overview and why this is a timely project and topic for discussion today.
Oh, you bet. And thanks, Chris. And thanks, everyone, for joining us. I'm going to try to talk less about geology today and more about the Stillwater Complex, its history in providing critical minerals, and our vision there for effectively the third wave of critical mineral supply from the Stillwater Igneous Complex. There's lots of technical info on our website, and you just saw actually the 5-minute technical video we did. That's a couple of weeks out of date now. There's been an expanded IP survey and drill results yesterday. Since that video was first produced, we're now updating it, but it does provide an excellent tour de force of our very large database. I also did a live in the Core Shack video just a month ago, which gives you a peek inside some of the things we're working on there. And of course, please email us, call us if you'd like more info. There's lots there on the website, in addition to questions at the end of this webinar. As Chris related, Group 10 Metals is a growth stage exploration company, and we are focused on platinum group and battery metals in first world jurisdictions. In addition, we have a gold property in Ontario. We recently signed an earn-in deal on that, and that gives us good exposure to the gold space. That's Heritage Mining, and they're IPOing shortly here. Our flagship Stillwater West project is a remarkable asset for Junior to have. Basically, we were in the right place at the right time a few years ago to acquire 100% ownership on nearly half the Stillwater Igneous Complex in Montana. And that's thanks to U.S. mining laws. Few folks knew that it was available. We worked with a local who had secured some ground. He also had the foresight to grab a lot of data with it. And that follows a bankruptcy of the companies that operated there before us. We worked with him to stake the rest, and we've since brought in this thinking that you'll hear about from South Africa and bigger mine models than the district had seen previously. What is strategic about the Stillwater Complex? What is significant about it? It has a history of producing large quantities of strategic metals. It produced a lot of high quality chrome during the 40s and 50s. And then starting in the 1980s with the discovery of the Stillwater mines, it's been the highest grade major platinum palladium mines in the world. And those have only expanded since that time. The complex is one of the biggest magmatic systems in the world, and it's one of the most productive. It's a very rare combination. Big magmatic systems are rare, and ones with grade and that attractive blend of both battery and precious metals, PGEs, are even more rare. The term magmatic is significant because all nickel sulfide deposits and all PGEs come from magmatic deposits. In fact, even the dirtier nickel laterite deposits that we see from Indonesia, New Caledonia, Philippines, other places, these are simply weathered nickel sulfide magmatic deposits. So in that sense, all nickel ultimately comes from magmatic sources. Excuse me. Stillwater complex is big. It's about 40 kilometers by 8 kilometers on surface. Currently hosts 87 million ounces of the highest grade palladium platinum in the world in one deposit, spans 40 kilometers as one magmatic horizon in that layered system. If you add 14 million ounces past production to that, it's by far the biggest of its type in the Western Hemisphere. It dominates North American PGE production. And it's really second in the world only to the giant mines of South Africa and Norilsk in Russia. Sibanye-Stillwater also produces nickel, copper, rhodium, gold, lesser PGEs, silver as well. So we're advancing a different deposit type at Stillwater from our neighbor. Sibanye is mining a JM Reef deposit, which is a classic narrow high-grade reef deposit. This is typical of the more conventional platinum mines in South Africa. We're the first to systematically go after Platte Reef style deposits at Stillwater. We consolidated the land position, we consolidated the database, and we went after this from an early stage. It's correct for the district, it's correct for where we are in the district. It refers to the big bulk mineable nickel copper sulfide deposits enriched in PGEs that you see in the Bushveld complex in parallel geology below the Marinsky and UG2 reefs. So in the same position stratigraphically in relative terms as we are in Montana. It's correct for the district, it's correct for where we are. We're applying those geologic models in Montana. So it's Platte Reef in Montana, essentially. That model is attractive because it allows economies of scale. These are bulk mining methods, so the operating costs are perhaps half on a per ounce basis than you'd get with the more narrow selective mining techniques. And it also offers that attractive balanced suite of commodities. So you're getting both nickel and copper. You're also getting PGEs at economic levels. And that's rare if you look at our peers in the PGE and nickel space. We also add cobalt in Montana, which they don't generally get in the Bushveld. We, as of October, have proven that model correct. And we announced our first resources of 2.4 million ounces PGEs and gold and 1.1 billion pounds of nickel, copper, and cobalt. It's a robust debut. It's a major milestone for Junior, and we are set to grow those nicely. In all cases across that core area, we see hundreds of meters at potential bulk mining grades, and then within that selectively higher grades, down to even tens of meters and a few meters at percent level. So we've got good optionality on mine method there at this early stage. We are indeed looking to expand those numbers. We drilled 14 holes last year, and those are working their way into an updated model. We've only received 6 of the assay results on those to date. 8 are still pending. You would have seen a release yesterday. We have a further 133 holes in the database, and we're looking to bring those into those models and let them guide us in exploration as we expand across the project. There are some excellent figures on the corporate presentation to better relate spatially how these deposits fit together. You saw some in the video at the intro there. Essentially, this is 5 deposits set within 12 kilometers of that highly prospective peridotite zone in the lower Stillwater complex. And those deposits are connected by multiple correlating high-level geophysical anomalies and also soil anomalies at surface. And that 12-kilometer core project area is set within 32 kilometers. So it's all open. All the deposits are open along trend and at depth. And we see a great potential to expand that. Resource expansion is our top priority, and so we see lots of room to grow. Our vision at Stillwater is to become a primary source of critical minerals and PGEs in the U.S. and at first world environmental standards. And we are also looking at carbon sequestration as part of that in a possible mine operation. And that would bring further benefits, of course, as you're pulling carbon from the atmosphere and putting it into tailings. We, of course, have the cleaner nickel sulfide ore, and that's a benefit, again, over the laterites we see in other jurisdictions. I'll wrap up here and get to the broader discussion with Jeff. We're well funded, we're well permitted, and we see great room to grow this as a source of PGEs and nickel, copper, cobalt in the U.S.
Thanks, Mike. Just good to set the stage for this discussion in terms of critical minerals in particular. So without further ado, we'll bring in Jeffrey Christian. So those of you who aren't aware, I guess I've known Jeff for about 8 years, but definitely one of the most knowledgeable experts on precious metals markets, commodities in general, I would say. Managing director of the CPM Group, which is a commodities research firm and advisor to, Jeff's been advisor to pretty much the who's who in the investing world, monetary or sovereign wealth funds, central banks, governments, you name it. Really needs little introduction there. So Jeff, it's good to see you again. I don't think we've seen each other in person for at least a couple of years here, but hopefully that gets remedied here this spring.
Yeah, it's probably PDAC 2020.
I think so, yeah, just a few months away. So a little plug there to come and see us all. Maybe we'll just jump right into things. We kind of have had a little bit of discussion, but really just jumping right in with nickel price. That certainly gathered the world's attention yesterday. And I mean, there's so much to discuss here. I don't really quite know where to begin. But let's just maybe start with nickel and what happened. Short squeeze, Norilsk.
Nickel has entered the rarefied club of being a precious metal. The price has shot up. I think it got to $100,000 per metric ton yesterday, today, and the London Metal Exchange suspended trading on it. With nickel and with a lot of metals, and we're saying this over and over again. We're talking about oil and wheat, gold, silver, platinum, palladium. You have a confluence of things happening right now. And the nickel price has been rising strongly, probably for a year. And it's been rising for three reasons. One is we're coming out of a period of depressed prices with the economic lockdown. The second thing is that supply and demand fundamentals have been tight and demand has been rising very strong. Nickel is critical for stainless steel, a wide range of stainless steels. And the demand for stainless steels has been rising very sharply, not just recovering from the lockdown, but actually rising much more sharply to higher levels than it was prior to the pandemic and economic lockdown. And then the third thing that was going on was investment demand predicated on the idea that the world was going to move very quickly toward electric vehicles, and you're going to need a lot of nickel, especially high purity nickel sulfate, for lithium ion batteries. So those things were pushing the price up. And then you had the war. And Norilsk is the world's largest nickel company, mining company. It produces more than 10%, I think much closer to like 13% of the world's nickel output. And there are sanctions and trade interruptions in getting nickel out of Russia. And that has then taken an event-driven spike on top of what's been a longer-term cyclical and secular increase in prices. So you've got this thing, and what we keep saying over the last 48 hours is investors have to discriminate between cyclical and secular, long-term, more persistent increases in prices, and event-driven spikes. And what we're seeing is a combination of both. It's very hard to disaggregate it, but it's quite clear if you look at a price chart for nickel or for gold or any of these other metals, that that's what's been going on, and that it will continue to go on. Once there's some resolution or some clear path as to what the resolution will be of the Russian invasion of Ukraine, then you probably will see the nickel price come off some. Meanwhile, the LME will struggle to reopen its contract. And then at some point, the price will come down, but we're still going to have very high nickel prices this year and going forward.
So this is just a spike up and maybe accelerated or created higher highs and lower lows faster than otherwise might have been the case.
I mean, we're in a war, and there's increased volatility across financial markets and across assets and across raw materials. And everybody in the world has to be saying to themselves, where am I going to get the nickel from my stainless steel? And
I guess, Mike, just maybe unpack quickly, Jeff, you commented the higher tenor sulfate nickel versus, say, the laterites and the nickel pig iron. Maybe, Mike, just unpack that real quick for what that means.
Sure. Well, 60% of the world's nickel comes from laterites, but this is really dirty nickel. It takes much more processing, much more carbon footprint to make that clean nickel and to make nickel sulfate that the battery manufacturers need. So nickel sulfide is much more desirable. It goes much more cleanly to nickel sulfate. And of course, our pitch, nickel sulfide in a first world jurisdiction, has to be that much better, right? It's basically it.
And that's, Jeff, so just back to your point, people, like you said, we're in a war, and we have to keep that in mind just in terms of obviously the human costs and be respectful of that. But discussing, like you said, where are people going to get these products from, and is there a long-term disruption in that supply potential from, say, Norilsk and others? And that will obviously impact the PGE market too, with Norilsk being a major palladium source.
Michael said it twice in first world jurisdiction. It's very important, and CPM Group is doing a lot of work now where we're finding institutional investors who are saying, the world's bifurcating already. Even before the Russian invasion of Ukraine, you had this bifurcation occurring where you've seen auto manufacturers and battery manufacturers and steel manufacturers and other manufacturers around the world, in Europe, in North America, both Canada and the United States, and increasingly in other places, starting to say, where am I getting my raw materials? And where am I getting my products? And that is going to continue to be an issue far beyond the resolution of the Ukrainian invasion. And it was pivoted primarily and focused primarily on China and how much high purity manganese sulfate for batteries comes out of China, and lithium and rare earths and all this stuff. But now with the Russian invasion, it's going to, the issue of where you're sourcing your materials becomes much more critical. And you're going to see an accelerated attention on home jurisdictions and secure jurisdictions like Canada or the United States as a place where investors are going to focus.
And that's, is there an accompanying divestment, I suppose, from those other projects and companies then into these more North American, or we'll call them first world for lack of a better term?
On trying to organize and fund an investment fund that will invest in energy materials, not just metals, but also hydrogen. But it will distinguish itself in that it will not invest in assets that have Chinese connections. And we're doing that predicated on the idea that over the next 3 to 5 to 10 years, you're going to see this bifurcation in commercial relations. Relations with China, between China and Canada, the United States and Europe, are more likely to grow more hostile. And you will see a premium placed on equities of mining companies in safe, close home jurisdictions. and you will see a discount relative to those companies of companies that have ties with Russia or China.
Yeah, more so, I guess, than we already just typically see with the jurisdictional risk component of an investment, I suppose, especially in the junior space. Mike, the critical minerals list then that was recently updated to include chromium, critical minerals list published by the US government, pretty much mirrors the same one in Canada. I mean, I guess that just goes to what Jeff was discussing about that focus from an investment point of view, but then a government point of view as well.
Yeah, and we're working with the USGS, of course, at Stillwater. They've been partners of ours for 4 years now. It's been a fantastic relationship. They've been studying the Stillwater complex for literally decades, and they write those lists of recommendations for the U.S. government. So, yeah, really, the total list is 8 that we have at Stillwater. It was 5, and then they added chrome, as you mentioned. That's now 6 on our deck. But you could also include ruthenium and iridium on there as well, because the lesser known PGEs round out that 6 to 8.
And this Stillwater and others in the U.S. have been these metal sources in the past that were to secure domestic supply. So we may see more development in that, and whether that translates to some of the permitting matters and so on, we'll see as well.
Well, to be clear, we've actually got our permits faster than I have in many jurisdictions. We've never had an issue at Stillwater, as you know.
Yeah,
this is past producing ground, and it's well known for its mineral potential.
That's actually, just to quickly divert to a Q&A question that was actually asked, so it's timely. It's just how has the state of Montana been to work with throughout the process, and specifically with the local, state, and federal agencies in Montana?
It's always been good for us, and I would say it's improving as well. Greg Gianforte is an engineer and pro mining, and he recognizes the value there. Oil and gas revenues are very big in Montana, especially in the east and the south. We're based out of Billings and then Red Lodge. Billings has 3 big oil refineries. You know, it's an industry town. The south, where we are, the mines are very well liked. High wages, good neighbor agreement in place, which makes them popular with locals. Yeah, it's been a great place for us to work.
So we started with nickel. It tends to be it was such a dramatic event that we saw, so it was worth starting there. And obviously Group 10 and our very few peers in North America will be keeping a close eye on that. Like Jeff said, we'll see it likely kind of pull back, but then resume that longer secular trend to the upside. I mean, we'll get to things like interest rates and fiscal and monetary policy, but what about the PGEs, Jeff? I mean, that's really CPM's wheelhouse.
Yeah. We've been following a lot of these things. Actually, I've been involved with Stillwater since the late 70s, when it was the original properties that became the Stillwater mine were owned by Anaconda, Chevron, and Johns Manville. And we've been involved in PGM since about that same period of time, which is why we were involved with them back then. And, we're looking at the metals, and palladium has had its run, rhodium has had its run, and our view is that they will stay strong for several years, those 2 metals, but platinum is going to play catch up. And so, we just finished our latest update of our supply, demand, and price projections to the year 2050. And that's predicated on the auto industry. And our view is that, when we look at the International Energy Agency says that even by 2050, you're going to have the major source of energy for humankind is going to be oil, petroleum products. And then the second largest is natural gas. All renewables combined will be 3rd place by 2050, according to their projections. But by 2040, coal will still be in 3rd place. Coal goes to 4th place by 2050. So the reality is that the world is going to continue to burn hydrocarbons, and is going to need platinum, palladium, and rhodium to clean the exhaust of burning those hydrocarbons for at least the next 3 decades, and probably far beyond that. So we've been looking at these metals and saying, okay, here are metals Rhodium goes from, $1,000 to $3,000, $30,000 to $12,000 to $20,000. That's now. And the reality is that it's going to stay volatile and it's going to stay high for a long time unless something dramatic that is totally unforeseen occurs. Palladium probably also stays high for the next several years. There is some scope for some weakness, but over the next 3 decades, you're still going to be using a lot of palladium, more palladium than now probably, in auto catalysts and semiconductors and electronics and chemical process catalysts. So it's going to stay high. And then platinum's going to play catch up because you're seeing the automakers who represent like 60% of palladium demand and 40% of platinum demand. You're seeing the automakers shift away from palladium intensity to more platinum intensity in their catalysts. And so that's starting to push the platinum price up. Platinum prices, traded between $800 and $1,000 for most of the time from 2015 to last year. And they spiked up to $1,300. They came back down to below $900 late last year. And now they're up around $1,150 as we speak. And our expectation is that $1,000 is the new floor and that the price moves up and moves up sharply over the next few years and over the next 30 years.
So the demand side, that clearly is going to at least maintain and likely grow. How has the supply side been and how does it look?
Well, there are a couple of things that are going on, and one of them we really can't work out. Yeah, but one of the things that's happened is you've had a lot of people on, the major platinum group metal producers in South Africa had a long period of decades of underperformance financially. And we have institutional investors who come to us, they buy our research and our consulting services. They say, PGMs look like a very interesting industry. What mining company do we invest in? And then they look at the South African major producers and they say, no, I'm not going to touch any of those. And then they look at Norilsk and they say, I'm not going to touch that. And then they start looking at junior companies like you guys who have growth prospects and don't have a track history of underperforming for shareholders, to be brutally honest. Now, that's changed a little bit in South Africa. The South African producers, by and large, have always counted on higher metal prices to save them from their management styles, if you will. But we've had this extended period of time of underinvestment in South Africa and misinvestment, where they've been investing in probably the wrong kind of capital expenditures as opposed to the ones that they really needed to work on. So they had high costs, they had low profitability, people were not investing in them. And that industry has been reforming, but it probably has further to reform. Meanwhile, you have smaller companies coming along like you guys, and you're saying, okay, here, we're going to do things more properly. And I think that that's one of the things that's happening. But in terms of total supply, South Africa production will probably rise modestly for the next few years, but you have this long period of underinvestment in long-term capital. And that's probably going to lead to another leg down in South African production beyond, say, 2024, 2024. So you could see lower production in South Africa. Now, Norilsk, different story, but everything's up for redefinition because of the Russian invasion of the Ukraine. Yeah. And it's hard to say what's going to happen. What we can say is the world needs Norilsk's nickel, and it also needs Norilsk's palladium, and to a lesser extent, platinum and rhodium. So Norilsk will probably survive, but you're probably going to have a rough patch of capital formation and capital investment in Norilsk that could lead to lower production. And you could have some major structural changes in the economy and political structure in Russia, because Russia's going to lose in Ukraine. Even if it wins and occupies Ukraine, it's going to lose. It's going to be detrimental to the Russian government, the Russian economy, and to Russia's standing in the world. And you're going to see a further reluctance to invest in companies like Norilsk, which is probably going to put downward pressure on their production too. So new production from companies like Metallic Minerals, Group 10, coming in and developing new properties, especially in North America, probably will gather more attention than otherwise would have happened even 2 or 3 months ago. So, supply is going to be constrained going forward from the major producers.
We started out with somewhat of an elephant in the room, but I think the real big one is the oil price and energy price as well. And to the extent that that's going to impact AISC and just mining costs and so on, does that become a bit of a, you need the supply. So despite the increase in costs, you need to go after it. So does that then impact the price as well? Or can you just talk about the oil situation and where that's going? And
it goes back to that thing that I said at the beginning, where you have to unbundle the cyclical and secular upward pressures on oil prices and the event-driven spike. And if you go back a year ago, when I was doing these kinds of webinars with other clients, and we were saying there were any number of oil experts, oil industry observers, analysts, and experts who were saying, look, oil trading at the time, $50, $55 a barrel, it's probably going to go toward $90 or $100 a barrel. And it was doing that. It was moving upward. And then this event, the Ukrainian war invasion, occurred, and now it's spiked up as high as I think Brent was $137 yesterday, and WTI was about 130. It's about 132 today, and Brent's down to about 135. You've seen that. So it's very important to look at a price chart for anything, and a long-term price chart, because if you look at oil, you can say, oh, well, okay, it spiked up almost as high as it was in February and March of 2008. But if you look at the oil price, it spiked up, it was rising consistently from, say, 2003 to 2007. And then all of the recessionary conditions and the global financial crisis occurred, interruptions in various production in various places, and the price shot sharply up to $150 for less than a day. And then it came back down. Within a year, it had touched $30 a barrel, and then it came back up to about $60 a barrel. So you should expect the same kind of thing now. And if you look at the oil price since 2009, the pattern has been the same. The oil price has been rising for a couple of years, and it was getting up into that $75, $80 a barrel phase. There was a lot of supply and demand resistance to that. Saudi Arabia and OPEC came along in December and said, we're not going to increase our production quotas any further. The price started to move a little bit higher, and then the Russians invaded the Ukraine, and it went to $130, $140. Once the Ukraine-Russian war is resolved or a resolution is in line, you should expect the oil price to come back down. Don't expect it to come back down to $50. And if it does, buy it at $50 because it's going to come back up. It will come down to some higher level. And it's probably going to be closer to $70, $80, maybe even $90 a barrel as the new floor price for oil. And that's going to go forward. And as I said, you look at energy technologies and the advent of electric vehicles and the electrification of the mode of transportation, as well as stationary power requirements. We're still going to be using oil for decades to come, despite what politicians and corporate titans might say. You simply can't make that transition to electricity away from oil that fast. So we're still going to be using oil for a long period of time, and that means higher oil prices.
And I guess on that, as that transition unfolds, and these things always do tend to take a lot longer than is arm waved about or advertised, but we like to, Mike, what's the term we like to refer to with our basket there being so internally hedged for
internally
that
hedged,
as that process unfolds. So we have the nickel for obviously still the dominant demand being stainless steel, but then for the batteries and the cobalt as well. But then the PGEs coming along with that for the transition. We do have a lot of questions kind of piling up, but we'd be remiss, I think, if we didn't talk about Fed policy, interest rates, and maybe what's to come. How does the central bank and how does the government in terms of fiscal policy react to this, U.S. government, that is?
Well, I think there are a few things. And first off, complicated. First, when you look at the relationship between, say, interest rates and metal prices, you have to realize that the effect on metal prices of rising interest rates depends on several factors. One is, why are interest rates rising? Another one is how low are interest rates, and another one is how high do you expect them to rise? So if you look at the current situation, it's radically different from where we were in 2008, 2007, or any other previous time. Okay, interest rates are rising, and they will rise because of inflation concerns in society, real actual inflation occurring and increasing. After 40 years of being 2-3%, we're now at 7% on headline, 7.5% headline, 6% core inflation. You have inflationary conditions, and the interest rates are rising because of that. That inflationary impulse that's pushing interest rates up is also pushing metal prices up. So from that perspective, the rise in interest rates is not necessarily a negative factor that would be expected to push prices down until the Fed gets inflation under control. And I have to say, I do think the Fed will get inflation under control. I'm not one of those, what you say, arm wavers who says that, the Fed has lost control. Anybody who thinks the Fed has lost control doesn't understand finance. The Fed has so many bullets that, it's like they got a 40-mile caravan of ammunition to fight inflation. The second thing is, how low or high are interest rates at the start? Nominal rates are 0, 25 bips. Real inflation adjusted rates are negative, big time negative, like negative 6% right now. So you can see an increase in interest rates, a sharp increase in interest rates that will keep interest rates low in real and nominal terms, too low for a lot of people to say, well, I'm not going to build that house. I'm not going to buy that car. Why would I bother to invest in commodities because interest rates are high? No one's going to say, oh, great, real interest rates have gone from negative 6% to negative 2%. I can buy a 10-year bond. No one's going to say, oh, great, nominal rates have gone from 0% to 3%. I'm going to buy a 10-year bond. So the level of interest rates that are existing now and that are expected to exist are so low that they probably will not have a negative effect. They'll have a minor negative effect on the economy overall, and then minor negative effect on the demand for industrial metals like steel and nickel and copper. But it's going to be a very minor effect, because what's pushing interest rates up is inflation and is positive for metal prices. And even with the most bullish expectations of interest rates for the next 10 years are very low. So that's not going to be a killjoy for precious or industrial metals.
Just looking at the metals prices as we speak, and gold is having a wild day, and silver as well. And the crude oil, it's just, everything is going bananas. And then you look at on the Canadian side, it's almost double. I mean, that's obviously currency driven, but the increase in the metals prices here in Canada is
another factor, another consequence of the Russian invasion of Ukraine is strength for the dollar, both near term, and we're seeing that now, and on a long-term basis. I mean, Europeans have been concerned about their proximity to the Soviet Union and then Russia for 80 years, and they still are. And if they were getting kind of lazy about thinking that way, Mr. Putin just reinforced that view that they should stop being lazy and think about it again. So there's going to be a concentrated refocusing on North America, which should benefit Canada, but it definitely will benefit the US dollar.
That, I think, is an excellent jumping off point for launching into the Q&A. And actually, the audience has grown instead of shrunk as the webinar has gone on. So I think that's a good sign.
That's a good sign.
Yeah. So let me just, we'll just stick with the broader macro global, I guess, theme for the moment, and then we'll get into a little more micro. But a question for Jeff: even after this conflict is resolved, and you somewhat answered it, do you believe the U.S. will reestablish business with Russia?
Yes, I think they will. I think one of the things that I find morally offensive is the extent to which various groups within the United States and Europe continue to do business with Russia, even as they're attacking the Ukraine. But I think that speaks to the fact that Russia has a lot of raw materials, oil, gas, timber, nickel, palladium, aluminum that the world needs. And it will, they will find a way to do business with the West. There may be a regime change in Russia. There may be some structural changes to the economy, but I do think that the West will resume trading with Russia insofar as it's reduced it any right now.
Are there any, this just a thought occurred to me, are there any kind of more near-term historical comparisons to this? I mean, obviously this is a full-on war, but the period of time during the Cuban Missile Crisis, for example, or the OPEC crisis in the early 70s, is there anything to draw from that in the markets?
Well, I think each crisis is sort of unique. And, the Cuban Missile Crisis occurred at a time when the US economy and the European economies were very highly regulated. People gave up a lot of economic liberty during the Depression and World War II. And that lasted into the late 70s, early 80s. And so when the Cuban Missile Crisis occurred, it was in the height of the Cold War, and you had highly regulated markets and economies in Europe and the United States. And so that allowed the governments to control flows more. And the flows were a lot less back then. So you didn't have as much trading. So I'm not quite sure that there are really good post-World War II corollaries to what we're seeing today in terms of the international politics and military balance.
Yeah. And the level of globalization that we're pulling back from now, that's unprecedented,
right,
in terms of trade and interaction.
Yeah, that's fair enough. I was just, as you see this unfold, try to put it into a little bit of context, and I kept going back, like you said, to the world wars, but I wasn't sure on that. Anyway, let's switch gears back to maybe something a little bit more homegrown here for Mike. As far as the critical minerals list, the update goes, what is the story behind not considering 1.3 billion pounds of chrome in the inaugural resources, which alone would have a value of X billion dollars?
Yeah, I mean, we tracked it. We are tracking it. It's reported as an inventory. We did not feel comfortable bringing it into the economics, is the point. So rhodium and chrome both are not included in those equivalence figures, and that's just us being conservative. Rhodium, we don't feel we have the data density yet in terms of right number of intervals assayed. Chrome brings other questions, and it occurs in high grades in chromite seams, and then more broadly as disseminated chromites. That takes an extra bit of thought. So we're just being conservative for now. I think you will, especially now that the U.S. has listed it as critical, I think you'll see us work to bring that into the fold as well.
And earlier question, just as far as what working in Montana was like, establishing that it's been quite good, and it's actually a very active state, and the counties where we are. Are you looking / exploring other Montana opportunities? Montana is obviously highly mineralized and could furnish more needed critical minerals.
Yeah, Group 10 is not unless they relate to Stillwater, because we are increasingly focused on Stillwater to the point that we're selling our other non-core assets. The broader group that Chris and I are part of, the Metallic Group, is always looking for good projects, and we are actually looking at some other things in Montana as a group. We love it there. Rio Tinto, of course, at the Madison project with American Pacific, and HPX Ivanhoe with Brixton at Hog Heaven. The majors like Montana as well. And Rio Tinto is doing that work with the USGS in the Butte area, right? That geophysical survey. So the state is attracting attention, and we're glad to be there.
The other point, of course, with Stillwater West is that it's massive, and
yes,
we have our hands full with plenty of targets to keep us busy. That we'll be looking to hit this season when we can.
That's not even a forward-looking statement. That's just, that's what it is.
We'll be looking to do that. Post some additional drill results here and a resource update, of course. You mentioned the other Metallic Group companies. Jeff, I don't think I specifically asked you about silver. I meant to. It's been behaving very strangely up until let's say today.
Well, strangely in that it hasn't raced as high as fast as gold, you mean?
Sure.
Yeah. What we've been picking up is that, more people around the world think of gold as that safe haven financial asset, and they move toward it. There are people who think of silver that way too, but gold is more universally thought that way. And what you've seen over the last couple of years is very strong growth in investment demand, especially in the second half of 2020 for gold, as people started worrying about certain aspects of the economy and the financial markets and stability and politics. And then that continued in 2021. With silver, it initially participated, but you had this wave of carnival barkers, coming into the silver market. And people were saying, okay, silver's gone from $14 to $24. And, CPM Group was saying, yeah, it's gone from $14 to $24. It could trade between $22 and $30 for the next year or two. And other people are saying, well, this is, these guys are like paid to be bearish on silver. They're saying it's only going to, trade up to $30. It's going to $50 or $100 or $300 or $1,000 silver. And you had a lot of investors who came into the market in the first quarter of last year, predicated on the snake oil sales, and they're disappointed. So if you look at Silver Eagle sales, in February, they were half of what they were in February of 2021, when the hysteria that silver was going to $100 was at its height, and there was no silver in the world. A year later, people know that silver reserves, mineable reserves of silver, are higher now than they've ever been before. They know that silver inventories in London and New York and Shanghai are either at record levels or very close to recent record levels. They know there's plenty of silver out there. And they've seen the silver price not go back to $30. So there's a lot of disappointment in silver that has kept the silver price underperforming relative to gold. That's what our analysis shakes out at. And that analysis is borne out by our talking to companies that sell precious metals to investors. There's been a lot of disenchantment or disillusionment by investors who drank the Kool-Aid and believed it, and now it's worn off, and they got to go back to class. Now in the last couple of days, silver's been playing catch up, because in a time of war, all of those cautions go to the wind.
Mm.
On a longer term path, silver, longer term forecast.
So we think that silver prices are going to rise sharply, probably not 2022 or 2023, but 2024, 5, 6, we think that you'll see record high gold and silver prices.
Mike, here's one, and let's see if you respond in the way that I expect you will. Having 8 to 10 critical minerals at Stillwater should have some direct benefit. Is there an Explorer example how it can play out?
Well, not really in North America per se. We're seeing quality nickel projects getting picked up. The Noront bidding war, that's some of our minerals in Northern Ontario, Ring of Fire, and of course Wyloo and BHP engaged in a bidding war there. That shows how rare these district scale critical minerals assets are. They do have chrome in that district as well. That's not impossible at Stillwater, right? We own half of a really good district on a global scale. I think really to go polymetallic and production stories of scale, you have to look to Ivanhoe, Platreef. Now fast tracking production, looks great, beautiful, rich ore body, and our direct parallel in terms of location, stratigraphy, geologic model. Everything else in North America is smaller, earlier stage, being advanced.
Yeah, I think I would probably point to, we've discussed kind of the analog of, or the comparable of Canada Nickel, which is a peer of ours based in Ontario, Canada, that shows scale and in the same similar ballpark on grade and metal suite, with some differences in terms of our levels of PGE and so on, but pointing to that kind of trajectory that they've had in terms of market cap as they've developed resources, grown them, gotten to the PEA stage and beyond. You really saw a sharp move up, and I would kind of point to that as aspirational is probably not right, but
where we'd like to go, absolutely. And that's a good example. I was trying to get more of the critical minerals in there because they of course don't have a lot of the PGEs. They're much more just nickel. But yes, in terms of scale, you're absolutely right. That's a big system. It looks in that sense like what we see at Stillwater. And that's where we'd like to be in terms of market cap too.
Well, and it really does highlight the point when there aren't a huge amount of peers of these types of projects. There are some, but they're very few. Jeff, quickly back to you. What is the China supply situation for nickel and PGEs? Are they
basically import platinum group metals? They do have some nickel production. They're not a particularly big nickel producer, I don't think. I think they're probably a net importer of nickel. But in terms of platinum group metals, they have virtually no mining of PGMs. So they're primarily importers of those metals.
Okay. Let's get that one. Oh, actually, just Jeff, another one for you. You mentioned all these bullets that the Fed has. Apart from interest rates, what are we looking at?
They can buy bonds. I mean, they have trillions of dollars of assets that they can buy bonds and flood the world with money. So that's one of the big factors. They can go back to monetary accommodation, and they can go far more accommodative than they have been in the last 2 years even. And then, yes, they have interest rates too.
Have they been monetizing debt?
Yes.
Okay. Yeah,
they've been doing that for 100 years.
The reason I phrase it like that, it was specifically asked, I think, in the most recent Jerome Powell testimony, and to his predecessor too, Bernanke, isn't this what you're doing, monetizing debt? And the response was something paraphrasing like, monetizing debt implies the intention to not pay it back, and we intend to, or to unpack it and so on. But there was no follow-up question. So I just wanted to ask that specifically of you. So thanks for the one-word answer.
Mike Bernanke, I can tell you the definition of money too.
Mike, do you have a clear path to production with regards to permits necessary?
Exploration permits, yes. Production permits, no. That we don't see a challenge with that, but we haven't gone that far down that road. We're an explorer, and we see great way to grow this and de-risk it. What comes next? If Ford, VW, or Elon Musk want to vertically integrate supply and go mining with us, I think we would take that on with the right backers. The most likely model is that we sell off to a major, right? After we've added significant value and de-risked the project. That's the traditional model, and it works well for a reason. So in that event, we would leave the permitting of production to somebody else. Our job is to de-risk it, which means looking down each pathway and building that PEA and de-risking it to that point. And I think we're doing really well. We certainly see no challenges to anything at Stillwater. It is a past producing district. Our ground has produced in the past. And of course, our neighbors are giants in the world producing right next door. So worth noting on that note, actually, that Sibanye is mining perhaps 2 kilometers north, maybe even 1 kilometer north from our hybrid deposit at their East Boulder operation. So they're already underground, just a short distance from us.
That's actually, well, you touched on it there. The next question was, what is your exit strategy?
That was kind of the answer right there. We're open for business. We've got the attention of the majors. The Stillwater address usually gets their attention, and then our work and the database keeps the conversation going. We have NDAs in place. We're open for business. We see a lot of value that we can add here first. So we're watching dilution, and we're watching for the right deal at the right time.
Just Jeff, back to you. You did touch on this, but it probably was a bit flown over. So specifically, do you see or hear clients from central bank funds, sectors asking whether they should be buying more metals as reserves?
Well, central banks only buy gold, and they seem to be able to buy gold and source gold pretty freely. Gold's a pretty liquid market by metals go. So you don't see that. What you do see, unfortunately, one of the things that we saw was sovereign wealth funds and some other large institutional investors that were moving into metals and mining, and they've kind of backed away in recent years, the last year or two. And one of the things that we are looking at right now is whether that ebb becomes a flow again, because we do think that they will be there. And what you're seeing some changes in institutional investor management of their overall assets, which is kind of negative for capital formation for smaller companies and individual companies, including mining companies, but not limited to mining companies. And then you also have seen some green-inspired hesitation about mining companies. Our expectation is that those hesitations will dissipate over the next year or two and start seeing it. So we're seeing the little green shoots of people asking questions about it and starting to reconsider how they deal with ESG questions when it comes to investing in the metals that are going to be required for future economic development.
Bitcoin.
Bitcoin my view has been that Bitcoin is like going to a casino. And I think the last couple of weeks have proven that. These things are very insecure. They're very volatile. They are the antithesis of gold, whereas gold is the ultimate tangible asset. Bitcoin and cryptocurrencies are the ultimate intangible assets. This is a promise online from someone you don't know and can't identify.
Right.
If you want to complain that a central bank issues currencies based on the full faith and credit in that central bank and its government, cryptocurrencies are valued on the full faith and credit of somebody anonymous who's probably a criminal that you can't trace. Yeah, so, and I think that's been proven out in the last couple of weeks. And there are any number of Russian oligarchs who are a little bit upset that they thought that cryptocurrencies were as good as gold. And now they don't have a certain portion of their wealth.
And the notion that they exist outside of the control of governments and so on.
Right.
Ability to shut that down. Mike, back to just a quick beer question here. What are some of the comparable PG and nickel deposits in safe jurisdictions?
It's a short list, of course, if you're talking about PGM and nickel and safe jurisdictions. The Wellgreen deposit, where you and I first met, Chris, in the Yukon, that's now Nickel Creek Platinum. That has a similar commodity mix to us. I would say it doesn't have the size potential given the size of the system around it, like we have at Stillwater. There are a couple in Ontario, Shakespeare deposit. Is that now Magna Mining, I think? Yeah. Talon is more nickel, but of course recently announced that concentrate deal with Tesla. I don't believe they have the PGEs as much as we do, but smaller, high grade, and well on its way to being a mine. Safe jurisdictions, Kevitsa, I guess, right? In production in Europe. And then you're on to Africa and Russia from there.
Yeah, with a handful of others. I mean, you could mention the Generations and Giga and stuff, but it's a short list.
Well, they don't. I was assuming nickels and PGE.
That's why the list is so short. Yeah. You have to go outside of that to mention some of these exploration peers. And of course,
well, certainly Generation for PGEs. They're advanced, and then Canada Nickel, Giga FPX with a different mineralogy. For nickel. Yeah.
Okay. Last couple quick questions on the project. Picket pin.
Oh, yeah. About what? I'm forgetting my numbers. 18 drill holes in it, and good signs of grade, but to date, not a focus. It's not something you can build ounces and pounds quickly. This is a reef structure. You see it in our images. It's actually it's above Sibanye in the layer stratigraphy. It's that thin claim block we have. Yeah, I think prospecting and geophysics at some point on that project, it's just not a priority for us. We see much lower hanging fruit that we can add ounces and pounds quickly in that lower system. That's been more than we could have dreamed for to date. So we will stay focused on that lower portion.
Okay, and finally, share structure. And just the general, fundamentals there.
Yeah, 167 million shares out. So at our current share price of 46 cents or so, it's a 73 million, I think, market cap Canadian. A little under 3 million cash Canadian in the bank, and 3.5 million Canadian dollars in near-term warrants and options that are coming in the money. So we're funded sufficient to do what we did last year and even more, 10,000 meter drill program. We certainly would like to do bigger and have the targets to do bigger. So we'll see what plays out in the next quarter here. Bigger picture, we have 16 million total in the money, warrants and options. So we have visibility to $19 million cash at present.
Okay, and I lied, actually. One more important one came in, and Jeff will just give you the floor for this as a jumping off point, and then maybe just recap kind of your thoughts on the commodity space, if you would. So the question is, as the Fed fights inflation, are you concerned about a general market correction? And maybe just from there, jump off and kind of recap your thoughts on the commodities in general, and maybe the nickel and PGE critical minerals specifically.
I have concerns or expectations of them. When you say general market correction, I assume you're talking primarily about the equity markets. And I do have concerns that you could see a significant decline is not necessarily because of the Fed's inflation fighting, although I think that that would definitely contribute to it and might actually be the occasion for it. But, you know, I think the S&P 500 earnings per share ratio is about 36 or 37 to 1 right now. Pretty high. And I think that you've had this extended period of time with monetary largesse and tax cuts going into the equity markets. And quite frankly, the stock market has primarily been driven by stock buybacks from the own corporations. In 2020, corporations in the United States bought more of their own shares than investors did. Yeah, and the share price did very well. They pulled back from their stock buyback programs last year, partly because of some changes in the tax codes and such. And the stock market had a much more rocky ride. So I would say that I have expectations that the stock market can correct, but I'm not one of those guys that's looking for a 50 or 80% decline in the stock market. I don't think that that's in the offing. I think that you're talking about, you know, cyclical corrections and relatively mild cyclical corrections. Now, we are talking about more hostile economic conditions, 24, 25, 26, possibility of a recession. And so you could see the stock market basically tread water for a couple of years and then start to run into problems. You know? And so if that goes into my overall market cap, you know, I do think that the demand for metals is rising, and we've gone through a ringer, and we've gone through several ringers. You know, I famously said in November of 2000 that I thought that the next several decades would see a more hostile political, economic, and financial environment than we saw in 1978, 1980. When gold went from $200 to $800 and silver from $5 to $50 and oil from $10 to $40, you know, and over the ensuing 22 years, that's come true. And it's gotten worse in the last couple of years. We've gone through some really nasty situations with the lockdown and now coming out of the lockdown, inflation, and now Russia invading Ukraine, which really completely changes the political globe. And, you know, if there's anybody who's really studying what's happening to Russia as a result of its invasion of the Ukraine, it's China. They're watching how the world treats Russia here because they have their own recidivist claims about other properties, you know. And so I do think that, you know, we've been going through these ringers. It's probably going to continue for a couple of years and maybe several years. And you're going to see periods of time, perhaps this year and next year, where that is reflected in higher gold and silver prices, and maybe industrial metals kind of tread water. Then you might see a recession where they all sort of suffer for a year or two. And that would be a gigantic buying opportunity, because then you come out of that and you have this recovery similar to what we've seen several times, you know, in the 1980s, the 1990s, the aughties, the teens. And I think that you could see very strong growth in demand. So we didn't really talk about copper. You know, I'm not particularly looking for sharply higher copper prices over the next 5 years, but over the 5 to 10 year period and the 5 to 20 year period, I'm much more optimistic that we'll see higher copper prices. And I think that that's what, you know, is happening. And it's interesting because, you know, you were asked about investor attitude, institutional investor attitudes. 30 years ago, we did 10-year projections and other people were doing 5-year projections. We're still doing primarily 10-year projections, but more and more we're finding institutional investors that want 20-year projections, or in the case of PGMs, 30-year projections. So one of the things that you're seeing is that institutional investors, big money, is taking a much longer term view of these investments.
Yeah, well, it's interesting with copper. I mean, even if it does just go maintain, let's call it for now, 460, 467 is spot right now. That's a lot better than $2 or sub $2 that we've seen in the not too distant past here. That's pretty much a wrap. We're actually over the 1 hour mark, which went fast. So that's a testament to the interesting conversation. And Jeff, we very much appreciate your time. Mike, any last thoughts, final thoughts?
That's excellent. Thank you, Jeff. Thank you, Chris. Watch us grow at Stillwater. I mean, this district is known for these critical commodities, and we've got them. We're bringing new thinking to it. And we're adding battery metals to the mix in addition to the PGEs that it's known for. And we're having a lot of fun with it. Thank you.
We're easy to find at group10metals.com, cpmgroup.com to find Jeff and their fine work and their reports there. And we're on the dreaded Twitter at Group10Metals. And I believe, Jeff, you are too at CPM Group, if I'm not mistaken.
Yes, I am.
Okay. Well, with that, then thanks everybody for tuning in and sticking with us for this hour. We had very little drop off, so I appreciate it. We will turn this into a recording and we have our version available and posted next today or tomorrow. So with that, gentlemen, have a great rest of day and week, and good luck. And our thoughts go to Ukraine and everybody suffering under that horrible situation as we speak. So with that, gentlemen,
Thank you. Cheers.